We're watching something truly extraordinary unfold in the markets right now. There's this historic level of panic in stocks, some really puzzling behavior from traditional safe havens, and then surprising strength in places you might not expect. So today, we're going to connect those dots and really dig into whether all this fear is actually a sign of a major shift in where money is headed. And just to put this into perspective, Goldman Sachs isn't just calling this a downturn. They've actually labeled it a 5 sigma event. Now, statistically, that means it's so ridiculously improbable it should almost never, ever happen. And yet, here we are. It's happening. And that tells you the old market playbooks, they might not apply anymore.
And look, this isn't just a gut feeling. The data is absolutely staggering. We've just seen long-only funds in the S&P 500 execute their largest single sale ever. I'm not talking about in the last decade or since 2008. I mean, in the entire recorded history of the index. This isn't just a correction, folks. This is what you call a historic capitulation.
Right, so to even begin to understand what could happen next, we've got to dissect the anatomy of this panic. We're going to look at what's causing it and the sheer jaw-dropping scale of the fear that has investors in its grip. This slide really lays it out. It's not just one thing, it's a perfect storm. You've got escalating geopolitical tensions, which always spooks the market. At the very same time, bond yields are just spiking across the board. That makes boring old government debt look safer and way more attractive, and it literally pulls money out of riskier stocks. All of this is happening while oil prices are hitting highs we haven't seen since 2022, and that squeezes everyone from consumers to corporations. The result from a technical standpoint? Well, both the S&P 500 and the Nasdaq have crashed below their 200-day moving averages, which is a classic textbook bearish signal. And this chart just brilliantly illustrates the exodus. We are seeing the largest capital outflow from S&P 500 ETFs ever recorded. I mean, just look at this chart. The current outflow completely dwarfs what we saw during the tariff crisis and even that big correction back in 2022. Money is just fleeing the main U.S. index at a rate we've never seen before. The options market is basically screaming the same thing. The total put-to-call ratio is over 1.0, and that's the key takeaway here. What it means is that for every single bet that the market's going up, there's more than one bet that it's going down. Traders are just overwhelmingly positioned for a brutal fall, whether they're hedging their portfolios or actively betting against the market. So you'd think with all this chaos, gold, the classic safe haven, would be absolutely shining, right? But instead, we're seeing something really, really strange. And that brings us to our next section, the Gold Enigma. So this leads us to a really critical question. We've got record fear, record outflows from stocks, spiking uncertainty, so why isn't gold soaring? It's not just failing to rally, it's actually lost its key moving averages and its whole uptrend has been broken. So what on earth is going on here? Well, the answer seems to lie in this huge divergence between different types of investors. As you can see here, retail is piling into gold in massive numbers, basically chasing safety at all-time highs. But on the flip side, for the first time in over 2 years, the big institutional players are net sellers. Now, they could be selling to cover losses somewhere else, or maybe they just see better hedges in this environment. Whatever the reason, they are offloading gold at the exact moment the little guy is panic buying. And the result of all that institutional selling pressure is pretty stark. Gold just had its worst month since 2013. Think about that. In a moment of supreme market fear, the traditional safe haven didn't just fail to provide refuge, it actually went down. This is a major, major break from historical patterns. But okay, while gold is faltering and stocks are in a full-blown panic, there's another asset class that's telling a completely different story. And that brings us to the remarkable relative strength that we're seeing in Bitcoin. I mean, the contrast in capital flows couldn't be more clear. As we just saw, money is pouring out of the S&P 500. At the exact same time, capital is still flowing consistently into Bitcoin ETFs. So while the traditional world is desperately de-risking, a whole segment of the market is actively putting capital into this digital asset. And when we dig into the on-chain data, we see even more underlying strength. First off, the amount of supply that's currently in loss is near historic bottom levels. That suggests that seller exhaustion is kicking in. Second, funding rates are negative. That just means it's expensive to be short, which is typically a bullish sign. Third, Open interest is climbing while the price is falling. That points to aggressive new short positions that could basically become fuel for a massive squeeze upwards. And maybe most importantly, while everyone else panics, institutions are quietly buying 3 times the amount of new Bitcoin being mined every month, just soaking up supply from the market. Now let's look at this historically, through the lens of the Bitcoin versus gold ratio. The last few major bear markets for this ratio lasted between 12 and 14 months, with these huge drawdowns of 75 to 84%. So what about the current cycle? Well, it's been 13 months with an 81% drawdown. The pattern is strikingly similar. It really suggests we are at, or very, very near, a major cyclical bottom for Bitcoin relative to gold.
So here's the crucial point, especially from a technical perspective. The MACD, a key momentum indicator for that Bitcoin versus gold chart, has fallen to its lowest level ever. It is now right on the verge of making a bullish crossover. In the past, when the MACD has crossed up from these deeply oversold levels, it has signaled the start of massive outperformance for Bitcoin. We're talking rallies from 280 to over 600% against gold.
So what do we have? We've got 2 completely opposite narratives playing out. On one side, historic 5 sigma levels of fear and capitulation in traditional markets. And on the other, all these signs of deep underlying strength and a potential historic turning point in an alternative asset. So how do we navigate this? You know, there's a classic market saying that just feels so relevant right now. When everyone expects something to happen, the opposite usually occurs. Right now, everyone expects a crash. Everyone is short. Everyone is protected. The real pain trade, the unexpected move, would be a powerful rebound. And this brings us to the core idea of this whole analysis. What if this isn't just a story of 2 separate markets? What if the historic sell-off we're seeing in stocks and the failure of gold as a safe haven, what if those are the very things driving capital to look for refuge and opportunity somewhere else? This widespread panic could actually be fueling a massive rotation into alternative assets. So we'll end with this question. While all the headlines are screaming crisis and the data is showing fear we've never seen before, could this extreme panic, this historic flushing out of the market, could it actually be the signal that we're at an inflection point? Is this the moment that marks not an end, but a new beginning for a totally different class of assets? That, I think, is the critical question we all need to consider.